Hello, everyone. This is Matthew Frailey with BreakpointTrades.com. We've been bringing you advanced technical analysis, market commentary, trade ideas, and mechanical trading algorithms, like you see here with our SPY system. We've been doing this since 2003 for individual traders and professional institutions, which I consult with on a weekly basis, and who happen to use my trading algorithms to manage their RIAs. Anyway, let's go ahead and get started. We got a lot to discuss. Breakpoint Trades has done a great job this year, I think. We warned about a bear market as early as last year in November and December. Our trading algorithms have absolutely killed it this year. So subscribers to Breakpoint Trades have had a great year, despite it being a bear market with the indexes down roughly 25 to 30%. I'm going to now start the main portion of this newsletter. And if you're new here on the YouTube channel, these comprehensive weekend newsletters take anywhere usually from about 50 minutes to 1 hour. Okay, so let's get started here. Hello, everyone. My name is Matthew Frailey with BreakpointTrades.com. First off, I hope everyone has had a nice weekend so far. It's Sunday evening, and this is the comprehensive market newsletter for October 9th, 2022. This newsletter is divided into 8 major table of contents. If you happen to be new here, these weekend newsletters can take anywhere from 40 minutes to an hour, usually a little less than an hour, but they're very comprehensive. We cover everything in a top-down fashion, all the major indexes, major sectors, indicators, bonds, US dollar, commodities, cryptocurrencies, precious metals, and sometimes it's some individual stocks. Okay. One of the first things I'm going to discuss after this, I'm going to discuss our mechanical trading algorithms, which have absolutely killed it this year. But anyway, as far as the market, here's the theme, long-term bear market. We called for a bear market back in January, well before most people, and we warned about it as early as November and December of last year. So long-term bear market, intermediate term downtrend, short-term downtrend. But we did put in a fourth wave bounce last week. That's our favored scenario. And so now our favorite scenario is that we're in wave 1 of 5. Okay, now we still haven't taken out the lows on the recent indexes, so anything could change. But for now, that's our favorite scenario, that we put in a wave 4 high last week, and we're moving down in wave 5. Okay. Obviously, remember, trends, surprises tend to happen in the direction of the trend, so respect that. Like I stated already, Steve and I have done a great job of calling the market this year, warned it about a bear market last year, confirmed it in January, plus our KISS trending systems used for 401k systems, they all exited back in January, and they did go long once in July into August, but otherwise they've done a damn good job. They're long only, okay? We also have our reversion to mean systems. Our 21 reversion to mean systems have caught 50 trades each on the SPY ETF and on ES. All those trade notifications get sent out to subscribers. These reversion to mean systems do better in high volatile conditions, volatile markets, bear markets like we have. So they've absolutely killed it this year. Short term, like I said, last week the market rallied strongly on Monday to Wednesday morning before topping out in what we were discussing as a wave 4 last week. All right. And then we had a big sell-off the rest of Wednesday, Thursday, and into Friday's close. All right. Even though it doesn't feel like it, the major indexes still closed up for the week, with the S&P gaining 1.5%, NASDAQ 0.7%, and the Russell 2000 small caps 2.25%. Okay. But again, our favorite view here in the short term is we put in a wave 4 high last week, and we go down on a wave. We're in some sort of wave 1 of 5 at the moment. Okay. News events this week, guys. All eyes on the CPI inflation data, just like last week on Friday. Folks watched that jobs report on Friday, and it came in a little better than expected. And, these days, good market news is bad market news, because the market, all the market cares about is the Fed will pivot or slow down on their rate hikes. That's all the market cares about. It's this recency bias over the last 12 years. Anyway, unfortunately, we also have to keep an eye on the Russian Ukraine situation and Putin and unfortunately the nukes. You know, it seems like we're closer to a possible nuclear confrontation since we've been in 1960s, which is unreal. Bonds closed down for the week, and 10-year Treasury yield closed up again. It hasn't taken out its recent highs yet. The dollar rallied last week, but has not taken out its recent highs yet. It's at the 61.8 fib, so that's a possible retracement area. Commodities had a strong week, but again, mainly because that strong crude oil, OPEC cut production, pushing prices higher. Precious metals also had a decent week. All right, let's move on to the first part of the newsletter. We'll get back to the general market, but I want to talk about the systems and some admin stuff. So item number 2 below, admin comments. First off, last week we put out a testimonials page. I got a link to it here. So those of you who are not seeing this on YouTube, but you're seeing this, you know, in your inbox, please put out a testimonial if you can. We've already had about 21, 22 submissions. And quite honestly, Steve and I are blown away by what many of you have written. And, you know, we're pretty humbled by the positive things people have said. You know, they almost look fake. In fact, they're so good. So please add a testimonial if you haven't done so. And if you're on our free newsletter, which I'm sending this out free this weekend, you got to read some of these because these are real testimonials by real subscribers. You know, some of these, a lot of our subscribers have been around since 2008, 2006, 2015, 2012, a long time. A lot of our subscribers stay for long periods of time. Breakpoint Trades isn't some shop who, you know, they do a big marketing and they get a bunch of new people in who then leave after a billing cycle, rinse and repeat. Most of our subscribers who come stay for many years. And anyway, so the other thing we're going to do, we are going to give a slight price increase in our memberships. Again, it's not much, maybe $10 to $15 a month for our 6-month memberships. All right. Again, we haven't had a price increase for about 11 years. All right. So that's not much to ask. Expenses have went up quite a bit, you know, over the last 11 years. Everyone's talking about inflation over the last year, but you know, we've held prices the same for 11 years, guys. Also, you know, just to put it into a little context, our systems, our reversion to mean systems, we've had 50 trades on SPY and 50 trades on ES. And I looked into it. The average profit on the ETF trades were $250. The average MES trades were $720. So multiply those by 50, guys. And so anyone who's worried about a $10 or $15 a month increase, I mean, come on. So, you know, if you're not a subscriber, I suggest if you add a membership now, and you can avoid you can get in for 6 months before we increase our prices here. So anyway, let's take a look at some of the reversion to mean systems, what they've done this year. Remember, they do better in high volatile bear markets, which we've had. Next, item number 3. So here's 2 of the recent reversion to mean systems. This shows you on ES. So last week we had 2 systems trigger short on the ES side of things. It didn't trigger on the SPY ETF, but it triggered on ES. That's why I run the systems on both ES and SPY, because again, they're different instruments, even though they're 99% correlated, obviously, because they're both related to the S&P 500. You'll still get different trades. And you could see on last week on the top one, this triggered on Thursday a short. That's the high, mid, low. And then the bottom one triggered on Tuesday last week, the QEBTS. So beautiful trades here. Again, in January of this year, I started sharing all the trade signals to the systems for both SPY and ES, and it's been very profitable and very popular here. But these systems took shorts, and we took profits on Friday, but we did keep a little bit left, which is good because futures are down tonight as I record this. So we still had a little piece on ES. By the way, if you don't trade futures, remember, you can always substitute one of the SPX related ETFs in place. SPY, SSO, SH, SDS, whatever. Next. So this image below, item number 4, it's a large image, but what I did here is just give me an example of how the systems, all these different trades that have occurred this year. So now this is on ES only. I have not made a similar image for SPY, but here's the 21 systems that triggered for the ES side instrument this year. Not all 21 systems triggered, guys. Remember, just because there's 21 subsystems, there's actually 22, but 21 of them are reversion to mean. Not all of them can trigger. There's a lot of systems that only occur in bull markets, stuff like that. So all the systems here that have the green candles, those are the longs. There's actually been more longs this year than shorts. And the ones on the right there are all the shorts, okay, that have triggered this year. And but you can see all kinds of variation to systems here. If you look at the upper left, the trend pullback, so that's a system that generally only occurs in bull markets. Did a few trades earlier in the year, but it's not going to be doing any trades. The S-trap, the QE swing 3 on the left, that only does trades in bull markets. So I did a trade in January, but you know, since then you haven't seen any trades. And you know, recently some of the more deep bear market systems occurred, such as the bear exhaustion. Long bear has been very active this year for obvious reasons. It's a system that does primarily long signals in bear markets. The bear exhaustion. The bull exhaustion did a trade earlier in the year, but you know, that is in bull markets. We're not in a bull market anymore. And all systems are meant to stand on their own. All systems have a profit percentage winning rate of around 80% to 90% on average. So each system is meant to stand on its own, and that's also part of the risk mitigation. Next. So image number 5. This shows you the live trades for ES side of things. For the website, I show as MES futures. That's the micro contract. And here's all the trades of this year. There's been over 50 trades, 52 trades. So you can see if you took all these trades, and this is a very small amount. Remember, MES is micro contract, micro futures. And you'd be up $46,000. The system's made 3,600 points on ES. Average trade for all the 52 systems, about $720. Again, there's some losers here and there, as you can see, but overall, very strong. And we still have an open short that we kept on Friday. You can see right here at the bottom. We did close out one on Friday as well for $750. Next. Image number 6 shows you all the trades that have occurred for SPY ETF this year. So there's been 50 of them. So we've actually had 2 more trades trigger on ES than SPY. Okay, they're not all the same. You can see for the SPY, we use $10,000 per trade, which in my opinion is very small, but it's just a baseline. And overall, you'd be up around just over $10,000 on this. Next, image number 7. I also give SPY options for the systems. We only do this for the SPY side of things, and you can see overall the trades of this year, you'd be up around $14,000 for that. Remember, these are sent out to all paying subscribers. You don't have to understand what the systems are doing, etc. You know, you can just follow the system trades. Okay. Your main job is figuring how much capital you allocate to the systems if they fit your risk profile. Okay. Overall, very good year for the systems. Next. Image number 8. This shows you our KISS trend system. This is our weekly version. So these KISS trend systems were designed by me a couple years ago as a way to, you know, this is mainly, I started this for family and friends as a way to keep them invested in bull markets, but have a stop that is constantly raised. Basically think of it as insurance for your 401k. So as price goes higher, you get a higher low stop DVT price is what we call it. Once the DVT price is hit, you get out. And the weekly version here got out in early January. 43.70 was its DVT. It went long basically at the lows of that February, March 2020. And it actually got out in February and avoided that crash. So again, insurance, right? The insurance stop was hit. It avoided the crash. It got back in, rode that bull market. Got out. It's been out most of the year. It did actually get in for a brief time in July into early August where it stalled, where it got out at that last DVT at 40.50. So it's been in cash. Currently, you can see on the weekly view, S&P is trying to hold this 200-week moving average. A lot of people are watching this 200-week moving average. I think it's going to ultimately break, but so far we've had a reaction bounce there. But the system has been in cash most of the year, and it actually made a little money there. Next. Chart 9, here's the daily version of the system, and it's done well this year. Again, it got out in January. It was long a brief time in March, got out. And then it got back long in July, right here. It gave 5 DVTs, insurance stops. Got out at 40.88 right here, DVT. So was hit on this large candle. And it's avoided this ever since. Okay. These aren't quick systems. These are meant more for 401ks where, maybe you only want to, at most you want to make 2 or 3 moves a year in your 401k. Since we're in a bear market, these systems are going to mainly be in cash. They're long only. Okay, they're not designed to short. Next. Moving back to the general market, image number 10 shows the index sector table, what transpired last week. Again, big loss, sell-off on Friday, big sell-off on Thursday. But even though it doesn't feel like it, the index is still closed up for the week, anywhere from 1.5% to 2.25%, with the Russell leading. Broad-based sell-off Thursday and Friday. Look at those losses on all the 21 sectors. Again, we still had a positive week for most things. And big moves in energy here, not surprising, with the move in crude oil. Biden is not happy about that, but it is what it is. Currencies, U.S. dollar, up 0.5% for the week. Still hasn't taken out the recent highs. Bitcoin held up fairly well for the week. Commodities mostly up for the week, especially crude oil. Again, that's the main thing that's affecting these commodities. Precious metals were up. Gold stocks were up, but they're lagging here a little bit. We'll keep an eye on that. And you can see the movement in bonds here for the week, which I'll discuss. Next. Item number 11 shows you the economic news calendar for this week. The big one is the CPI data. Everyone's going to be watching that. And of course, geopolitical, you have to keep an eye on Ukrainian, Russia, Putin, nukes, unfortunately. All right, let's jump to the index charts. So the first chart below, item number 12, is a weekly snapshot of the 5 key major indexes. So you can see the bear market, which started in January. And the indexes have all been making lower lows, lower highs in these general kind of expanding triangle type patterns. Okay. By the way, guys, in August, Steve warned about a 700-point pullback in the market when a lot of folks were getting bowled up, including some folks on our website. Well, that proved to be correct. You can see the indexes. Well, the Dow's a little bit below the June lows. The S&P got a little bit below there. NASDAQ right there. If you look here, all these indexes, the weeklies, have these doji candlesticks. Next. Item number 13. This is a monthly view of the major indexes. So you can see major indexes down at their lower Bollinger Bands or a little bit below. Here's the previous bull market lows in 2009. I added fibs. So the S&P still not down to there. Remember, guys, in a normal bear markets, I looked over the last 100 years, bear markets usually retrace at least 38% of previous bull markets. So we're still not there. Now the NASDAQ is there. We think this bear market, as we said all year long, has potential to be one heck of a doozy. Maybe even worse than 2008. Next. Chart number 14, here's the daily view of the major indexes. So what you see here mainly is the indexes last week on Tuesday and Wednesday stalled right at their middle Bollinger Bands, essentially the 20-day moving average. If you didn't know that, the middle Bollinger Band is the 20-day moving average. Okay. Again, they haven't taken out their lows, so is it possible the bulls could, recover it here? It is, but for now, we favor a new low that we're in some sort of fifth wave decline. Now let's move on to the S&P charts, which is our proxy. First off, we'll start with the bigger picture here. This chart, each candlestick represents 1 year. So basically, think about this, guys. Longer term, markets always revert back to the mean. So the mean is the 9-year EMA in this example. This is a yearly candlestick chart. So my theme all year has been the S&P got too far extended. Look how far away it got away from its 9-year EMA here at the close of last year. Unsustainable, as we said. Reverting back to the mean. We've had a big reversion, but have we even made it back to the mean yet? No. We still got a long way to go. Still 500 or so points just back to the 9 EMA. And you can see some of these previous bear markets, you'll undercut the 9 EMA. So that's why one of our targets is the lower 33,000s, 3,200-ish. I think over time we could work below that, but not all in one fashion. Okay. Next. Chart number 16, here's the monthly view. This is a chart we showed for the last couple years. So late last year, we favored an end to that bull market as a wave 5. You can see how we have it labeled. And that ended up playing out. Most of the other Elliott waivers weren't calling for bear markets or confirming it until much later in the year. We had this count last year, and we confirmed it in January. Next. Chart number 17, here's another monthly view. Shows you back to early 90s. And you can see this channel. One target over time that we're targeting is the uptrend channel going back to 2009 over time. This indicator here, a nifty one, the stochastic, just a very standard indicator, works well on monthly time frames. Whenever it falls below 50%, you're in bear markets. In bull markets, it tends to bounce off the 50% area, as you can see here. Obviously, it fell well below the 50% months ago, thus confirming bear market. But again, we confirmed the bear market well before that occurred. Next. Chart number 18, here's another monthly chart showing it back to 2009 lows. These are some of our targets over time. There's a demand zone down here in the lower, 32, 3,300 area, and over time. And here's some of the long-term trend lines. One connecting the the 2009 lows to the March lows. Another connecting the bodies. Okay. Next. Chart number 19, here's a weekly view of the major indexes. This is this expanding diagonal down. You can see last week we closed right at the 200-week moving average. We bounced off of it, but then we pulled back. Now we have a doji candlestick here. This shows you price by volume. You can see kind of a weak support here by price by volume. This is actually one of the lowest right here. So your larger supports are down in this range, which is why we think over time the S&P will make it down to these areas. Next. Chart number 20. If you want one of our views that we're looking for this, how this bear market to unfold. So here's a weekly view of the S&P. So we're in this expanding pattern. Wave 1, 2, 3, 4, 5. Now under this, remember wave 4 can overlap wave 1 because of this expanding diagonal. Okay. And so we're viewing this where we're in a wave 5. This is our favored pattern back in August when we topped out. And over time, maybe work to the lower 3,000s, 32, 33, 3,400. Then we'll put in a pretty decent low as a wave A. Remember, bear markets are corrections of previous bull markets. So large ABC pattern. So that'll complete 5 waves of wave A. Then you get an ABC. After that, guys, we should have a pretty sizable rally. You know, say even early next year. Could be 30%, 40%. Go back up to 4,000 maybe. Okay. This will be a pretty good buying opportunity, and it will be a multi-month rally, not just, you know, a rally that lasts for a week or so. But overall, we do believe it'll end. A lot of people will be bullish. They'll think the bull market ended here. They'll think we're in a new bull market, but it'll be a wave B, and then once that's over, we'll go down yet again to new lows in C. Okay, but otherwise, you know, this is our, you know, now we'll have to see where this wave 5 ultimately ends for the wave A. All right. That's the bigger picture view that we favor right now. By the way, guys, here's another little system tip for you. 60 length stochastic, 10 length. Whenever the 60 length gets near 50%, if the faster stochastic is overbought, that gives you a very objective short trade. In fact, this is a system that I have coded. So you can see it visually there. It makes sense. You can use this on any time frame. This is a weekly, but you can use this on a 1-minute chart if you want. Doesn't set up that often, but it's very reliable. Next. Chart number 21, here's a weekly Rinko chart. I like these Rinko charts because they're pretty clean. This is each box is a 30 points. I also have price by volume here, and you can see how price stalled at resistance here back in August. This was support, resistance. We're losing the support, and there's kind of a thin zone here. Look at your price by volume. It's the thinnest volume into this area. These are your longer term supports now down into here. Next. Chart number 22, here's the cycles. This goes along with our KISS systems, but so last week on Monday we had a DeMark 13. We rallied from there, stalled near here, now we're pulling back again. We haven't taken out the lows here, so is it possible we could still form a higher low and bounce? It is possible. But for now, we view this as starting a wave 5. Maybe we get a bounce here. It's a wave 2 of 5, something like that. The moving average ribbon's still pretty wide, so keep an open mind. We do have an end of bear cycle here on the half day. Price is above that ATR. So now if you start breaking that ATR, that would be pretty bearish, but that is a support. For now, there's a DeMark 9 on a 60. Next. Moving down to the smaller time frames, chart number 23, here's the daily. So on the daily, again, you can see we're basically retesting the June lows. Here I added a clean channel. This is our favorite view, wave 1, 2, 3, 4, 5 down. Okay. Next. Chart number 24, here's the half day chart. Same pattern. 1, 2, 3, 4. We're in this channel. By the way, that last rally, 223 points, very close to that previous rally, 232. Perfect symmetry where it failed. Now, if this does make a new low here, we will have a potential MACD divergence there. Next. Chart number 25, here's a 2-hour view, shows you the same channel. Again, our favorite view, some sort of wave 4. If we get a bounce in here, you know, we would view this maybe... It's a little bit thick. Let me redo this, guys. We would view it maybe as a wave 2 of 5 and then down. All right. So if we get a bounce on Monday, let's say we get that, I'm not viewing that as anything major at this point. Maybe as a wave 2 of 5. Next. Chart number 26. 60-minute view shows you the same channel. Next. Chart number 27, 15-minute view. All right, let's move on to the Qs. Chart number 28, triple Qs, monthly chart, down to this 50-week moving average here in red. And actually 50-month moving average, I'm sorry. These are some of our demand zones right into here and down here over time. You can see here 14 stochastic on the monthly chart as well, which I showed you on the weekly S&P above, or monthly S&P. Next. Chart Chart 29, here's the daily view. Similar look to the S&P. Here I have the tight downtrend channel to monitor right near the lows. Next. Chart 30, here's a clean Rinko chart of the triple Qs. Each box is 3 points. You can see we have a support in here. Now, below here, guys, there's a big air pocket into here, all the way down to about 230. Take a look at your price by volume, how light that is there. So little support right there. Next. Chart 31, here's the Qs KISS daily. Again, similar look, basically the same look as the S&P. It hit its DVT insurance stop back here in August, and it's been out ever since. Last week on that bounce, the moving average ribbon was pinching on the bearish side, so we got that flush on Thursday and Friday. Next. Chart 32, here's the cycles. Again, similar look to the S&P, but it's weaker. You can see the half day is well below its ATR, unlike the S&P. Next. Chart 32, IWM small caps. They're still trying to hang on to this little support zone. Below that, your next big support is down into here. Next. Chart 34, here's the daily. Now, the small caps are holding up a little bit better than the general market. They're still quite a bit off those lows. I know a lot of people are pointing to that the market's going to bounce here. And it's possible, but again, guys, we don't follow this too much at the moment. And remember, this is small caps. You know, our main focus is the S&P and the Qs, larger market. Next. Chart 35, IWM small caps. Last week, we stalled right at this resistance. You can see this area. Previous support became resistance. All right. That does it for the major indexes, guys. Now let's look at some market sectors. Chart 36, XLE Energy. Strong rally last week. Not surprising with that move in crude oil. Now it's testing this extended trend line here, which is a resistance. Keep an eye on that. But clearly this area is very strong. Next. Chart 37, here's a bigger daily chart. You can see have this trend line going all the way back to 2020, which we never lost. Kind of wondering if this could form a larger coil pattern, maybe. Next. Chart 38, ExxonMobil weekly chart. Had a coil pattern, and it's almost at the highs here, guys. So this has been a very good stock this year. We pointed out energy stocks as the place to be way back last December and early January. Obviously, they had a lot of consolidation chopping around in the summer, early fall, but, you know, they've done well. Next. Chart 39, Devon Energy. Basically a vertical rally here off that recent low. Possible coil area. Again, this area is holding up well, and that move last week at the OPEC only helps that. Next. Looking at some other sectors, chart 40, XLU Utilities. We had a fifth wave double top back here in September. Decline. It's now basically testing the February and June lows. It is quite oversold in the short term. Little RSI divergence there, wide ribbon. But again, divergence is only a yellow sign. It doesn't mean you get a bounce from it. Next. Chart 41, transports, weekly view. Down to this area. Basically, I'm showing this as a weekly channel. Next. Chart 42, XLK technology, moves with the triple Qs, shown as a weekly channel. Next. Chart 43, XLC communication. It contains a lot of those old FANG names, and you can see they've been much weaker than the Qs this year. In fact, they've retraced a lot of this move off the 2020 lows. Guys, I believe this whole move off the 2020 lows will be retraced. That last move stalled right at symmetry. Again, we do have a little MACD divergence for now. We had it last week. But is it going to produce a better bounce here, or are we going to puke first to these other areas? Next. Chart 44, XLF financials. Still trying to hang on to this little support area. These are some larger demands below in the long term. Next. Chart 45, consumer staples. Downtrending, new low. We do have a little RSI divergence in the moment. Next. Chart 46, there's the weekly view, bigger picture. See your 200-week moving averages. Still quite a bit below. Next. Chart number 47, IYR real estate. Talk about a disaster. Look at this sell-off. Again, are you surprised with 30-year mortgages at 7% now? Next. Chart number 48, there's the weekly view. It is now retraced almost 61.8% of the move off the 2020 lows from the 2021 highs. That 61 fib may be an area to watch. That's an important fib. But, man, it's had a heck of a retracement. Not surprising with what's going on there. The housing market has only begun to pull back, guys. All right, now let's look at some market indicators. Chart number 49, the VIX. So the VIX rallied last week off its middle Bollinger Band. You know, one thing the VIX hasn't done this year, if you look, it has been unable to spike above these, you know, mid-30 area, upper 30s. That's stalled every rally in the VIX this year. If the market really has a pretty good washout, I imagine it'll eventually break out of here, finally washing out the masses. The reason the VIX hasn't had a big move up into the 40s or 50s is because the general population hasn't capitulated yet. That eventually will happen. Next. Chart number 50, here's the NYAD advanced decline issues. Now, one thing to note, the NYAD is at a new low here. The S&P has a higher low so far. Now, if this was reversed, if the NYAD had a higher low, that would be a positive, but this leads. Next. Chart number 51, here's the NASDAQ, new highs minus new lows. One thing to note, we do have a big divergence forming here. So, you know, the NASDAQ could make a pretty good new low and we could still have a divergence. But again, that's not something to use in the short term as a buy signal, but just pointing that out, something to monitor. Next. Chart number 52, here's the NASI indicator, NASDAQ Summation Index. It's been a pretty useful indicator. You know, when it's been below zero all year, except for that rally into, you know, August, and then it quickly reverted. Next. Here's some other versions. Here's the NASI with the 2 and 5 EMA. That's been actually very responsive. Little buy signal here in, what is that? June. Sell signal there in mid-August. Very timely. And no buy signals on this decline. So that's been very useful. Next. Chart number 54. Here's the NASI with plotted as Rinko. This is a nice view as well whenever you get the parabolic buys and sells. Nice sell there in August, very timely. Again, if you're watching this on YouTube, if you subscribe to our newsletter at Breakpoint Trades, we actually give you the live chart URLs of this so you can use on your own instead of seeing a static image on YouTube. Next. Chart number 55, here's the NYMO. One positive perhaps here is the S&P is close to a new low here, but the NYMO is still way up here. We may form a positive divergence here if the S&P makes a new low. Next. Chart number 56, this has been a very good chart. So what's been leading the market this year is high yield corporate bonds. Okay, this is a 60-minute chart. I'm showing back to end of May, but whenever you see a divergence between high yield corporate and the S&P, notice that is called all these major tops and bottoms. We had it back in early June. High yield corporate was making a lower high. S&P made a higher high. That warned you of a decline. We got it. You had the opposite there in June. High yield corporate was leading up, higher low, S&P not. That ended up pushing the S&P up. You got another divergence here. You got a negative divergence here in August. S&P made that new high. This made a lower high. Perfectly called that high. Got another divergence here in early September. Called for that rally. And another divergence into September. And I called for that recent rally. So this has been pretty good, guys. I suggest following this going forward. Next. Chart number 57. Here's a short-term view. Again, you can see that these last divergences played out really well. One slight positive here short term, guys, is that bonds or high yield corporate is not even retraced 38%. whereas the S&P is retraced well over 61.8%. So it's not leading down at the moment. Next, moving on to bonds. So chart number 28, TLT, 20-year bonds. Here's the bigger picture view. Bonds, again, have been downtrending essentially since late 2021, and really they topped out in 2020. Okay. There is still some MACD divergence here, but as of yet, no real bounce. Next. Chart number 59, here's the daily. This continues its downtrend. We're monitoring this downtrend line in the short term. Next. Chart number 60, SPAB bond aggregate. And this contains a mixture of all the bonds, from high-yield corporate to junk bonds to government bonds. And you can see it's basically retraced all that 2020 lows. One hell of a bear market in bonds. Next. Chart number 61, here's high-yield corporate. Again, we just discussed that above. Keep an eye on this. It is holding up a little better here short term for the market. Next. Chart number 62, 10-year treasury yield. Rallied perfectly off this support. But is it going to make a new high here or a lower high is my question. We'll see this week. Next. Moving on to currencies, US dollar. That's been the big boy. Big perfect double bottom in 2021. And it's just been basically a parabolic uptrend. Last week it pulled back, but found support at its 9-week EMA. That's your first major support. Next. Chart number 64, here's the daily. Again, we broke a short-term parabolic move. Nice bounce last week. Here's the 61 fib right at 113. I'm wondering if it's gonna form a lower high there or not. Something I'm watching this week. Next. Chart number 65, there's a zoomed out view of the daily. It is still holding this longer parabolic move though. Remember guys, this big move in the dollar that we've had this year is definitely going to affect earnings of major US companies that sell overseas. No doubt about it. Next. Chart number 66, UUP, 2-hour time frame. You can see it's at the 61 fib, as I noted. Next. Chart number 67, a zoomed out view of the US dollar going back to the 90s. Steve showed this wave pattern last week, this channel. We're in this wave 5. One hell of a rally over the last couple of years, especially this year. Finally, chart number 68, Japanese yen. Almost back to the 1998 lows. Not surprising. Boy, they've destroyed their currency. Next. Moving on to commodities. Chart number 69, DBC, up 8.7% for the week. The bullish view would have this as a large ABC pattern. You can see it regained its broken trend line. Again, a big part of this is the move in crude oil last week, but clearly long-term uptrend. Next. Chart number 70, crude oil on the daily. We were showing this as a falling wedge. I showed this a couple weeks ago. We broke out of it, and we've exceeded this move, so symmetry break. 200-day moving average is up here, something to watch. Next. Chart number 71, DBC. This chart got out of order. I meant to have this with DBC above, but one thing to note, guys, people are calling for an end of the commodity bull market, over the last month, but look, bull market began back here, and all it did was pull back to this area, which I had drawn previously, which became support, didn't it? Next. Chart number 72, DBC on the daily. Back above the 200-day moving average. Next. Chart number 73, copper. So far, bear flag look to it. Next. Chart number 74, copper on the daily. Monitoring this channel short term. Sold off from the upper channel line last week. Next. Chart number 75, DBA. Possible bear flag or wedge here that we showed. Bear flag a couple weeks ago. Still intact. Next. Chart number 76, Bitcoin. Now it continues stubbornly to hold on to this support. We'll see if it breaks or not. Still holding. Next. Chart number 77, Ethereum, still holding this little trend line support for now. Next, Moving on to the final part of our newsletter, precious metals. This is the daily chart of gold. Stalled right at the 50-day moving average last week and downtrend line. Now we'll see if it can form a higher low or not. Really needs to do so and break out of here. Okay. If you're a gold bug, you want to see a higher low. You want to see it break out of this channel. Next, chart 79, silver. This has been leading lately, but it too, you want to see it stay out of this broken pattern. Next, chart 80, GDX. Gold stocks tend to lead. They were up for the week, but they gave a lot of that back. We'll see what happens this week. We do have a nice divergence down here, the previous low. Some big supports down here, but doesn't mean it's possible that it bottomed, but we still need to see evidence. Next, chart 81. Here's a daily view of gold. Again, the stocks tend to lead. Unfortunately, last week late they started underperforming here. You can see on the ratio GDX GLD. Now, what you have a possible completed fifth wave here, but you want to see this form a higher low. We broke out of the channel line, right? So ideally, price would find support on this channel line, or maybe not retrace more than 50% of this. So, but ideally, I'd rather have it find support on this channel line. We'll see if we get that or not. Next, chart 82, GDX on the 2-hour view. We showed last week. We broke this downtrend channel. Again, you want to hold this channel line. So far, we got a little symmetry move here. I added fibs. You really wouldn't want price to go below that 61 fib for sure. Moving average ribbon still bullishly stacked. And finally, chart 83, SILJ. That's the silver junior ETF. I'm pulling back on Friday. Now, guys, let's look at a few large individual stocks. So chart 84, here's AMD. As you know, they reported last week. Very ugly. Look at this downtrend. Big haircut, 164 back in December. Now below 60. Lower channel line could be a target short term. Next, chart 85. Here's a zoomed out view. So this is a chart we had drawn early in the year. We had an air pocket here, which I drew this months ago. We've now almost filled that. This is your next demand zone. Next, chart 86, Tesla. I've been telling you guys that they're going to come for Tesla. It was stubbornly holding up. Well, the last couple weeks, it has gotten knocked down. Look at this puppy. Next, chart 87. Here's a zoomed out view. Do you think Tesla's done? I don't think so. Longer term, I could see it going down to these lower areas longer term. Next, chart 88, Apple. Here's a long-term, this is a logarithmic chart, trend line for 2009. Could Apple eventually come down to the low 100s over time? Don't think it can't happen, guys. Next, chart 89, here's another view. I've shown a linear chart here, just showing you how far this sucker moved in the last few years. A lot of that may unwind. Next, chart 90, there's the daily view of Apple. Back when Apple was near the highs here in August, everyone thought it was going to make a new high. Steve and I called that a wave B. We thought it would come down, and that's exactly what has happened. We did get some bounce off this initial support. Next, chart 91, Meta, Facebook. We plotted this last year, guys, as a wave 5, and boy, has that played out. This is one of our longer-term targets. It's almost there. Finally, chart 92, NVIDIA, another stock that's been coming way, way down. Next, chart 93, ExxonMobil. Again, what's done well this year? A lot of the energy names like this. All right, guys, that does it. We will see what happens this week on Monday, and, of course, see how the CPI data comes on Wednesday. Have a good Sunday, rest of your evening, and, or good morning if you're listening to this on Monday or Tuesday of this week. Take care.